Directly from 42nd Street in Midtown Manhattan, New York. I am your host Harbin and you're watching my channel YOLO, You Only Live Once. Hello everyone. Today is Sunday, March 5th, and I am here to basically bring a month in review. So let's talk about March and how March is going to basically impact your financial situation, March of 2023. So if we look at the market summary, Friday, the Nasdaq Composite closed at 11,689, while end of February it was 11,455. End of January it was 11,584, and during the March of 2022 it started with 13,532 while ended with 14,442. So that means March was a good month last year for the financial market, and the start of March, so that means the Friday, first week of March basically ended on a good note. Even though we have seen the inflation actually picked up in February, and it has again gone against most of the financial experts' prediction. If you have looked at my videos last year, I have said that I have made basically 2 years treasury bond ladder, because I was anticipating that both in the year of later half of 2022 and then throughout 2023 the interest rate will be going up. And one of my now 6 month or 1.5 year treasury maturity is coming up in March, and the interest rates are actually at a good point that it will actually help me invest for a long term. I hope everybody who is basically looking for some fixed income asset should basically invest in treasury bonds at this point and over the next few months also, because the Fed is going to increase again 50 basis points most likely in the month of March, and they may actually go for another or couple more till June of or September of 2023. They are not going to taper off before next year anyway, so you will be able to actually get to invest in treasury bond for another 6 months or so. I have my last of the treasury bond lettering coming to maturity in September, so it seems like to be in good position for that. If you look at S&P 500 also shows the similar behavior as Nasdaq Composite as well as Dow Jones Industrial Average. If you look at 10 years in treasury yield, it was hovering around 1.86% last March, and now it is 4%, started this month at 4%. So it's a very healthy yield. I think I will encourage people to basically move to fixed asset if possible. If you look at gold is down with respect to last year. It was 1942, started the month and then ended with 1936. But ever since it has been sliding, and it had picked up from February, it ended with 1825 and now it's 1855. Similarly, the US dollar, if you look, basically has been on the strong side. It was giving 0.89 euros, and now it's actually giving 0.94 with respect to last year. Similarly, last year it was giving 0.76, 74 or 75 British pound, and now it is giving 0.8367. So It has been strong against both these currencies. Similarly, it has been strong against Indian rupees. It was giving 75.28 in the March of 2022. Now it's giving at 82 and 35. So if you look at US dollar, have been very strong. Crude oil basically has gone down. That actually shows the inflation with respect to last year is lower, but it is still basically picked up again in the month of February. So that was a big change. Other than that, the prediction for the month of March has been always stronger for the securities stocks, and I basically anticipate market to basically slowly go up or trickle up in the month of March. So as you have seen my videos, if you look, you can click on the single stock concentration video. I anticipated that in month of March that the stock market will actually be robust and will give me a good chance to basically diversify from my single stock concentration. And I prepared for that by basically buying into other stocks during the month of July to December last year, 2022, for the amount of money I want to basically diversify. So I already bought that much amount in the accounts, and I basically wanted to liquidate during the month of March, and I did that on Friday. I will steadily basically do more this month as well as over this year, so that to stay below 10% in a single stock concentration. So if you look, this is a growth stock portfolio. I basically started building this last year. If you have seen my video before on when I basically liquid in 2021, I liquid a lot of Facebook stocks during 2021 to actually move money in my IRA account to treasury bonds. But then when the Facebook stock actually went down from 300 something to 150, or it actually went down to below 170, I started buying it. And then I kept on buying it till it actually hit $90. So my previously plan was that to actually do the tax loss harvesting. So I actually bought first a lot of 200 in 150 to 170 range. And then I basically thought that I will take loss on that 200 stock in 2022, and basically so I bought by October 31st and November 2nd, because you need 31 days to actually get that. And so I did it in end of October, early November, so that the 31 days pass, I will actually be able to sell that in December, and then for 2022 I can take loss on that. But then the market actually drastically recovered, at least this stock recovered drastically, and both my 150 to 170 also started looking good. So then I thought there's no point taking the loss, because it's going to give me actually profit on it. So now it's still short term. If you see, I actually started buying in July and bought till November. So I'll wait for this to actually go long term, so that I can recognize capital gains instead of actually short term gains on this one. But you can see it has given me nice returns on the total almost 45% return. So this was a good basically buy. Then the other stock which I actually had diversified in 2021 was Tesla, but then it basically started dropping drastically when it actually came down before 120. I thought like, okay, it's a good opportunity, and then I started to buy it again. I bought it at 111 and 106, and if you look at, actually I bought in January of 2023, January 3rd 2023. I wanted to buy it on it actually touched 102 at one point, but I was not in a position to buy at that time, and that's why I couldn't buy it. It happened on January 5th, I think. And the point I was trying to make is basically you have to look for the opportunity and make most of it, because they only come knocking for a short term. Because if you look, it's January to March, only 2 months, the stock has actually recovered very nicely. It's up around 80% in just 2 months. So something like that, it's like you have to keep looking for these things and then actually act on it when it happens. And similarly, if you look at, this was Netflix, and again the same thing happened. Starting April of 2022 to June of 2022, I basically start buying it once it basically dropped below 225 after our quarterly result, and then I thought it's actually a good buy, but then it dropped below 200, and then I thought like, okay, it might be actually even good opportunity to add to it, and then I add to it at 177 also. Since then it has recovered very nicely, and is giving me a 57% return on it. Then the same thing will happen with coin. Actually, I wanted to participate in the IPO, but I didn't. Luckily, I didn't do that. And then it basically dropped below 100. I thought basically might be a good option, but then I waited till it actually dropped below $50, and then I actually bought it. I bought this because I have been trading Bitcoins at Coinbase for a long time, so I thought like, okay, it might be a good platform, and so that's another thing, like, okay, don't buy it just basically it sounds nice unless you have been dealing with it. I've been dealing with Coinbase for a long time, and I thought like, okay, since I have assets with that company, so I know that, okay, it's a first platform for Bitcoins, and it has been very steady and managed well, so I was able to actually buy it when it actually dropped drastically. Then if you look at I started doing the same thing with Google. The Google stock dropped below 110. Then I thought it might be a good opportunity to buy. Then it dropped below 105, so I added to it. Then it dropped below 100, so I added some more to it. But then it dropped below 90, so I still added to it. So now it's basically have been still hovering around 93, $94. So, but I still have confidence on Google. I think it'll go up. So it's long-term hold, but I can do a couple of things with that. I can do tax loss harvesting with that, and that's why I have 300 of lower this thing, and then I can actually just basically sell the higher 400 and then wait. Basically, if they stay low more than 31 days, I can recover that and then keep the same account number. But even if that's not the case, I can if it goes lower. So the strategy is that if it go lower below 90, I can actually knock off the upper one and buy the lower one first, and then after 31 days I can actually knock off the upper one. The same thing with Amazon. When Amazon dropped below 105, I thought it was a buy, but then it dropped below 90 and then it went below 85. But now it has recovered to 94, 95. So again, the same thing. This is one company I think it's a long-term hold. So point is like, okay, in the short term, you might basically see the stock dipping, but if you have confidence in the company, you should hold and don't basically just wash it away. So that's the thing basically. If you look at this, I started this account just last year, and then it still has returned 30%. Okay, so these are the growth stocks. So another thing I started was the dividend stocks. So if you look at the dividend stocks, so they have returned nice too, but it's basically it's 10% only. And the point to see that between the dividend and the growth stocks is that the growth stocks gives you better return by appreciating, while dividend stock gives you dividend, and that's why the appreciation is considerable less. So I thought like, okay, I'll put the same amount between the two set of stocks and see like, okay, how they will fare over the year. So if you see the growth stocks, so if you remove 66,000 from it, so the cost price was around 220,000 in the growth stock, but it gives 30% return, while in the dividend stocks, if you subtract 23, so it was again 220, but it gave only 10% return. So the total price is 244 with respect to 286,000. So even though like so this is what like, okay, if you look at my single stock concentration, I wanted to basically move away from my single stock concentration because I was anticipating by March of 2023 I'll have a single stock concentration of more than 20%, but I didn't want to basically diversify and buy other stock at the same time, because the principle was that, okay, by March of 2023 all the stocks would have recovered, and then there will not be any benefit from moving from one stock to another stock. You still have to do it, because if you are getting exposure to one stock for more than 20% of your portfolio, there's no point basically keeping one stock, because then you diversify, and then at that point the stocks are at the same price, so the opportunity for them to go up will remain same. But if you take that okay, in future when the market is low and you realize that, okay, 6-7 months from now you basically get into a situation where you will have a single stock concentration, you start taking the steps at that time, and then basically benefit from it, from the gain of it. But the thing is that you are increasing the exposure to the stock during that time, but once you actually do the balancing, you will be able to actually see that you have taken the benefit of a stock going up to begin with. So I wanted to basically diversify around 450 500k, and then I started building these two accounts. If you look at, both were 220,000, and the growth stock has appreciated much more, around 30%. The dividend stocks have matured, appreciated less, around 10%, but they are going to give dividends. And then you want to basically see if that is actually good for you. If you look at estimated investment income, so it is going to give me for 2023, for next 1 year, $4,690 in dividend from that dividend stock. So you can add that to but even if you add that dividend back to the dividend stocks, you will see that okay, it is still not going to match the growth stocks appreciation. So even if you add that $6,000 or $5,000 to this, you'll get 250,000. While compared to that, the growth stock has appreciated to 286,000 from the same 220,000 investment. So does that make that okay sense that you only invest in growth stock and not invest in dividend stock at all? But that's not true. If the growth stocks appreciate more in the same time, they depreciate also a lot faster. So that means if the market was going negative, the same set of stocks would have gone the other way, 30% down, while your dividend stock would have gone 10% down. So if you cannot take that type of hit, you should basically then better off with the growth stocks or the dividend stocks, because the market is unpredictable. It's not like it's going to go up and down because you want it to. It goes up and down because of the market parameter. But yeah, there are certain things you can assess that okay, in 2021 when I diversified, I knew that okay, market was high for a long time, so there are more chances of it to go down than to go up. The same thing happened when 2022 market was down, and then I thought like okay, there are more chances for that the market will go up than to go down. But when I started investing, it still went down for a couple of months before it actually reached a so-called bottom and then started picking up. So that will always be the case, but you have to actually take into account the market fluctuation. If you feel that okay, you cannot take it, then you're better off investing in either a fixed stock, a fixed income, or basically investing in mutual funds. But mutual fund go down too, basically it's just not under your control. So look at the fixed income assets which I have. Most of them are down because I invested them in 2022. So but this doesn't impact you because this is like really not down. If you keep them to maturity, you will actually get your money worth. It's just that okay, the inflation is high and the value of the money basically goes down if you put them in bonds or you stay cash in the bank, because the like $100 remains $100, but if inflation is high, its value actually become 94. So even though you still have $100 in your bank, the goods you can buy worth is only $94. So that's what it shows. But not necessarily that okay, you're losing money when you're keeping cash in the bank. So that's what you have to realize, that okay, when you invest in cash, CDs or bonds, you get your money, but if the inflation is high over the years, you are actually keeping the money in the bank or getting some interest in the CDs or bonds. That value will decline if the inflation is higher. So that's the point most of the financial advisors make towards the stock, that okay, even though the stock fluctuates more, the value of the stock is going to basically gives you a better protection against inflation in the long run. Yeah, in the short runs, what happens that okay, the market can go up and down, but in the long run, the market always recover, and then it will basically beat inflation. But not everybody is cut for stocks, so you have to basically invest according to your mentality. If you are a cash person, you should then invest in bonds, and then don't look at the unrealized gain or loss, because it's not going to impact you. What you are going to get is this, which is the quantity of par value what you have bought. So the thing is that like this is the way to read this is that okay, you have a 75,000 quantity of bonds, the present value is 93.52, but that doesn't care, because if you hold it to maturity, you will get $75,000. Similarly, like if you look at this one, you have 225,000 quantity, even though the value is 99.79, you don't care, because if you look for maturity, you will actually be getting 225,000. Even though it says you are in gain of 3,786, but that's the gain is that okay, if you sell it now, you will only get 224,000, which is more than the value it has at this point. So you're getting that 3,786, because if you put it for the rest of the time, it's maturing on March 23rd. So that means if you sell it now, you get 3,786,000, but you're still not getting 225. You're still getting 224,527, because if you reinvest 224,527 for the next 20 days, you will still not make 225,000. So that's why the point with the bonds are that okay, if you're holding to maturity, you are getting what you are getting. In the meantime, the value might actually fluctuate depending on the interest rates are going up or interest rates are going down. For this particular security, when it was invested for a higher yield to worst than what the higher yield to worst for 20 days is. So that means you are actually seeing the benefit, but if you hold it to maturity, you only going to get 225, and you're not going to get 228 at any time. So that's the thing with the bonds. The value you are holding is the value of this quantity, but at any point in time, based on the inflation, that value is less or less more, depending on whether the inflation is less or inflation is more. But you get what you actually put it for. So you never actually make a loss on your bonds. The only thing that happens is the value of the money goes down or up if the inflation is high. So I hope basically you got a good overview of how the market going to be in the month of March. I anticipate that the inflation number in February is higher than anticipated, so Fed is going to basically raise the rate by another 50 basis point, and market traditionally has been strong in the month of March. It's a good time to basically go diversify your single stock concentration because the market will be healthy, so you might be able to actually get a good price, and then you might be able to go shop for bargain if you want to. But the rule is that you should shop for bargain before you thought of diversifying. If you like this video, please subscribe to the channel, like my video, leave a comment, and share the videos if possible. Thanks, and have a great day.